Good morning, everyone. Thanks, Danielle, for the introduction. And it's lovely to see you on this chilly December morning. It keeps trying to become winter, hasn't quite decided that it's getting cold yet, but nonetheless, we are getting hints that it's on the way. And with cold weather comes year end, and with year end comes philanthropic giving. So I'm very pleased to spend a few minutes with you just sharing top tax saving tips and some ideas for strategies for philanthropy. I want to just qualify this at the beginning by sharing what I am and what I am not. I am a chartered advisor in philanthropy, which is a specialty that helps people discern philanthropic giving priorities. And I'm an accredited estate planner, which demonstrates a knowledge of estate planning practices. But I am not an estate planning attorney and I am not an accountant. So everything that I share with you today, I share for informational purposes only. And I encourage you, if any of the ideas and suggestions, and please forgive me, I should have muted this phone before we started. Hang on one second. There we go. Everything I share with you, I'm sharing for informational purposes only, and I encourage you to consult with your own advisor before making a decision about how to give. So I thought I would start this by just giving a quick refresher on the charitable fund options at the Community Foundation. Because what we find is that most folks are primarily familiar with donor advised funds, and I expect that most of the folks on this call have a donor advised fund. And many people don't realize or don't remember that the Community Foundation actually offers several ways to create philanthropic funds. And this is important in the context of the tax saving information that I'm going to share, because some of the opportunities that exists may not be used for donor advised funds, but there are various effective giving strategies, and they can be done with other kinds of funds at the Community Foundation. So I thought it would be helpful to just put this reminder at the top of the presentation. So donor advised funds you're familiar with, you, the donor, make a gift. Our minimum to set up a donor advised fund is $10,000. By law, by IRS code, you retain the right to both recommend where the money goes from that fund, as long as it's for a qualified charitable purpose. And you also retain the right to recommend where the money is invested. You may name successor advisors to that fund, and that fund can be part of a family giving opportunity. Community foundations across the country offer donor advised funds. So do most of the commercial gift funds like Fidelity, Vanguard. But what the Fidelities and Vanguards don't do is they don't offer the other kinds of funds that community foundations typically offer. And these are first, Field of Interest Fund, which is a fund established to support a charitable field designated by you, the donor. So that field can be very broad or can be very specific, but it's not an organization, it's a charitable purpose. We have many of these, for example, for animal welfare, and that's done because folks know that those organizations may change, but that purpose will always exist. We are encouraging funds in the strategic areas that the Community Foundation is leading right now, which includes closing the racial wealth gap and addressing strategies for neighborhoods. So we're offering opportunities for collective giving through field of interest funds that amplify impact in particular purpose areas. Last year, one of the funds that we offered in response to COVID, for example, was a field of interest fund that was directed to supporting arts organizations led by people of color in the. So we administered that fund. It was set up by a donor, and it enabled collective philanthropy. So key takeaway here, charitable field, Community Foundation does making, not the donor. So we select the organizations. Designated fund is what it sounds like, which is a fund that designates a particular organization to get a distribution annually. So these have to be either temporarily endowed or preferably permanently endowed. And I should mention that many of our field of interest funds are also permanently endowed. They're created to create a permanent difference in the area that the donor is directing. These are very popular with donors, both during lifetime, and I'll mention why shortly, but also as a way of perpetuating support for organizations into the future through an estate plan. So it's got to be a qualified charity, but any qualified charity may be designated. And then finally, scholarship funds. And scholarship funds help students with need of financial assistance be able to attend college. The Community Foundation is establishing a regional scholarship specifically, again, within the context of the strategic direction that we've adopted of closing the racial wealth gap. The criteria is going to be solely an income need criteria. So donors may either set up their own scholarship fund with criteria that we then administer, or may participate in the scholarship fund that the Community Foundation is establishing. So current giving. So these are the year-end tax tips. First and foremost, you may be aware of what are called qualified charitable distributions from IRAs, or QCDs, as they're affectionately called by your financial advisor. The nonprofit sector likes to call them IRA rollover gifts, and there's some folks that even marketed them with a dog rolling over, and you can roll over your IRA in the same way. But effectively, what you're doing is you're making a distribution from your IRA directly to a qualified charity, so a 501c3 organization. You must be at least 70 and a half, so 70.5, in order to begin making distributions from your IRA. Currently, the limit is 100,000, which can include your mandatory minimum distribution. There has been some confusion because the Tax Cut and Jobs Act increased the age at which you had to start taking your required minimum distribution to 72. However, you may still make an IRA rollover when you become 70 and a half. So many folks have been confused by that. This is a highly beneficial strategy, particularly for folks that otherwise would not be able to itemize their income taxes. As I'm certain you all know, that same tax cut or the Tax Cut and Jobs Act of 2017 changed the standard deduction rules and changed what may be deducted in itemized taxes. So the standard deduction went up to $12,000 for an individual, $24,000 for a couple, and it also limited what are called SALT taxes, state local income tax deductions, and limited them so extremely that particularly in this part of the country, it's often not possible to deduct the entirety of the mortgage interest payments that are being made and other state and local taxes. So it's often very difficult for couples in particular to get over, well, individuals or couples to get over that 24,000. The benefit of doing a charitable IRA rollover is that that rollover does not come into your income for income tax purposes. So if you have a mandatory minimum distribution of $50,000 and you don't need that money, you have other sources of income, you can make that rollover gift, and that money will not be taxed. And that money, of course, would otherwise be taxed as ordinary income, which is the highest tax rate at which you can be taxed. You will not be able to take a charitable income tax deduction, but the good news is that doesn't really matter because you're not being taxed on that income. So if you have your accountant do the math, you may be surprised to see that that is actually more effective as a tax strategy than making a cash gift and then taking the corresponding income tax deduction. So why did I give you that little primer on the types of funds that you can establish at the Community Foundation? I did that because you may not make an IRA charitable rollover gift into a donor advised fund. This is one of the rules that Congress passed lots of conversations about why not DAFs, but that's not the purview of this presentation. What that means is that if you make an IRA rollover gift and designate it for your donor advised fund, you will get a phone call from Russella or a member of our donor services team sharing the bad news that we cannot accept that gift for that donor advised fund. And that does happen with some frequency. You may, however, use it to establish a field of interest fund, a designated fund, or a scholarship fund. So I encourage you, as you're thinking about this, if you're meeting with your accountant and this is a strategy, or your financial advisor, and this is a strategy that appeals to you, I encourage you to consider establishing a field of interest or a designated fund. Keep in mind, you will not be able to recommend the grants. You will either put them plug and play through a designated fund. You'll pick an organization, it'll get that money every year, or you'll name a charitable field and our team will pick the grantees. Nonetheless, it will achieve your charitable objectives. Okay, bundling into donor advised funds. So we were talking about those changes in the standard deduction, and that has created the problem, as I mentioned, that it's now very difficult to get above that standard deduction in order to itemize. I think these are approximate numbers, but the percentage of folks that itemize went from in the 30s, low 30s range to, I think, now 8 to 10% of the population. So most folks are not itemizing annually. However, if you're philanthropic and you have organizations that you give to annually and you know you're going to want to support them with an annual gift in the next few years, and you're in the fortunate position that you have some disposable income and you're able to make a larger gift in a given year into a donor advised fund, then one very effective strategy is to make a large gift in 1 year. We're a public charity, so you get the same charitable income tax deduction that you would with a gift to any public charity. And then you may grant that money over a period of people typically do it 2 or 3 years. And so in the year that you do that, you would then itemize your taxes, and you'd be surprised by the math. When I became an accredited estate planning advisor, I actually had to do the math on these deductions, and it's not linear, so you actually get a greater level of deduction in the year that you bundle into a donor advised fund. Don't ask me to do that math again. That was a couple of years ago, but your accountant can do that. And I really encourage you to sit down and talk with him or her and run the numbers to see if that's a beneficial strategy. Another strategy that's in place just through the end of this year, so this is highly appropriate for this conversation, is that the portion of your adjusted gross income that may be deducted for gifts of cash last year and again this year is 100%. So the Tax Cut and Jobs Act that passed now 4 years ago, 2017, I think I said 3 earlier, changed the portion of your adjusted gross income for gifts of cash that may be deducted up to 60%. It had been 50 for many years, 50%. Now that portion is 100%. But again, that may not be made to a donor advised fund. So this is, again, something worth discussing with your accountant, particularly if you're in a circumstance where you have a lot of assets, but your annual adjusted gross income is low. So it may be possible for you to make a gift this year that's up to 100% if you, again, have that disposable cash. This, again, has to be cash. Cash is writing a check. But if you do that, you may be able to deduct this year up to 100% of your adjusted gross income, which of course can be, highly beneficial from a tax perspective. So again, not into a donor advised fund. You can do it into a field of interest. You can do it into a designated fund. And of course, you can also do that for your favorite charities, including the Community Foundation. We'll get to that in a moment. So other gifts that are always worth considering, again, as part of a larger financial plan, gifts of real property. I met with a fellow yesterday whose considering opening a current fund, and he's also going to then name the community foundation in his estate plan. He has a paid up property, and he feels like he doesn't really need, he may at a certain point not need that property. He may actually gift that property during his lifetime to the fund. The benefit of this is that he bought this property years ago. It has a very low cost basis relative to what it would now sell for. And this is a typical issue in the DC market. And so in this circumstance, he'll get a full fair market value deduction. The community foundation, he would actually title that property to the community foundation. We would then sell the property. The proceeds would go into his charitable fund. We're currently in the process of receiving gifts of life insurance. So if you have paid up life insurance policies that you don't really need anymore and they're sitting on a shelf, it's worth actually getting, an appraisal of them for their current value and determining whether you might not just gift that for charitable purposes. And we can assist with gift of collectibles. They're a little more complicated beyond the time we have here, but happy to talk with you about that. So I just want to give you one very important reminder on current gifts. And you would be surprised that there are a lot of folks that still don't know this. If you own stock, and this is better for actual individual brokerage account shares of stock, although it can also be done with mutual funds. A little more complicated with mutual funds, longer runway to make the gift. You need to let us know, like now, if you think you might want to gift a mutual fund. But for shares of stock, it's a very simple process to transfer those shares of stock from your account to the community foundation's account. You will receive the full fair market value. So if you bought Microsoft shares at $10 and they're now $1,000, you will get a charitable income tax deduction for $1,000. So you get the full fair market value. That's calculated by the mean of the value on a given day, the high and the low. So some days can be tricky, like Monday, where the market fluctuated enormously, and your deduction is going to be the mean of the high and the low on that day. But that deduction is going to be that $1,000, but that gift only cost you $10. So it is extremely financially advantageous because essentially you're getting an income tax deduction for the current value of that stock, no matter what you initially paid for that stock. There is a limitation of how much you may deduct. You're allowed to deduct up to 30% of your adjusted gross income. So always, if you're getting ready to make a gift, talk with your financial advisor. It's good to look at your portfolio from the perspective if you have stocks you love, but you've owned them a long time and they have a low cost basis, you can always gift those stocks and rebuy them at the current share price. But again, that's a strategy to consider with your financial advisor. So I think I'm actually going to pause here because I'm transitioning into another section. But before I do, I'd like to know if there are any questions.
Becca, we have two questions in the chat. The first was about IRA distributions. If you establish a designated fund to receive those distributions, do they have to go to that fund every year, or can you establish multiple destinations to receive IRA distributions?
Yeah, good question. So if you wanted multiple organizations, you could do it one of two ways. When you set up the designated fund, say you wanted to support two, you could designate those two organizations when it's established and designate what portion, what percentage you wanted each organization to receive. That would be a permanently endowed fund. Just as a reminder, a permanently endowed fund generates an annual available to spend, which we calculate as 5% of the previous 3 years total return. So we average the quarterly returns over 3 years and then take 5% of the total balance of the fund. So it's approximately 5%. Years when you set up a fund, in year 2, we're just distributing the income until we get to that 3-year trailing period. So this should be for organizations you really love. If you do the math, when you set up a permanent endowment, if you multiply, say you set up a designated fund with your full $100,000 that you're allowed to give as an IRA rollover gift. That would generate $5,000 a year. If you multiply that by 20, you get 100,000, which means after 20 years, you're giving more money than that initial 100,000, and you're doing it in perpetuity. So a lot of people think about this as perpetuating their annual support. If you've been giving to 2 or 3 favorite charities every year, and you know, even when you're no longer here, you're going to want to keep supporting them, this is a great way to do it. You may set up a term endowment, so you could set up a designated fund and of 10 years. You have to set the term with us. The last year would be a bigger distribution because it would distribute whatever income that fund's earned. But really, this is the most effective strategy for permanently endowed funds. Now, say next year, there are other organizations, you would have to set up a new designated fund. So we can't adapt an existing designated fund once it's set up, but the process to open them is a simple fund agreement, and then you would just create that new designation in the subsequent year.
One other question, can designated funds be established going to religious institutions?
Sure, yeah, qualified charity. All right, I'm going to keep rocking and rolling here. All right, now we're on my favorite subject. And why is estate giving my favorite subject? It's my favorite subject because it's that little piece of ourselves, besides our children, which hopefully we all love. The other thing that we leave is a legacy of the causes, the values, the purposes that we believed in. And that can be done through an estate or legacy gift at the Community Foundation. So this is a little bonus section of this presentation on estate giving. And the first is very straightforward. It's a bequest through a will, trust, or beneficiary designation. Increasingly, revocable living trusts are becoming more common. They're simpler because they don't have to be probated. And in fact, this last couple of years with COVID-19, that having a revocable living trust as opposed to a will was an advantage if you were unfortunate enough to pass away, because the probate courts just completely backed up. It's taking forever at least in the district, to get estates probated. So with a revocable living trust, what you're doing is you're basically entitling all your assets to that trust. And when you pass away, there's a trustee who then administers those assets according to your designations. And you can name as beneficiary on your financial accounts, so your bank accounts, your investment accounts, your IRAs, you can name the Community Foundation directly as a beneficiary, and that will avoid either administration through the trust or probate court. But one way or another, we encourage everyone to have some form of provision for legacy giving. You can also take advantage of what are called life income gifts. So life income gifts are kind of what they sound like. And I didn't include these in current giving strategies because the Community Foundation doesn't offer these. So this is just really informational in case this is something that would be an effective strategy for you to do through an estate plan, or in the case of charitable gift annuities, through another organization. So life income gifts are what they sound like. You make a gift during your life, although you can do these through an estate plan, and you then receive income either for a term of years or for life in return for that gift. So with a charitable gift annuity, what's happening is that gift is earning a rate of return based on a federal rate that's set monthly. You're getting a payment that's partially the investment return and partially a return of your principal. You get that payment for as long as you live, and then what's left goes to the charity. Why do I mention this in this context? Well, you can actually set up a charitable gift annuity through your estate plan and name your children as the beneficiary of that charitable gift annuity. And because the law changed with IRAs with the Secure Act, so there used to be the case if you left your IRA to your children or other heirs, those beneficiaries could basically take the payment on that IRA over or their lifetimes, over, the child's lifetime. That's no longer the case. That IRA has to be spent within 10 years. Why did Congress do that? More tax revenue from the spending of the IRAs, because IRAs are taxed as ordinary income when you take the distribution. They grow tax deferred. You pay ordinary income when you take the distribution, and they're distributed according to a calculation based on the beneficiary's age. So now if you have a circumstance where your kids are inheriting an IRA and they already have other substantial sources of income, that's going to bump their entire tax bracket. It's going to be heavily taxed asset. So there are ways that you can prevent that. And one of them is leaving that IRA either to a charitable gift annuity or to a charitable remainder unit trust. Now, charitable remainder unit trust is also a life income gift. So basically, you're making a gift. You're getting typically a gift for life or a term of years up to 20 years. Whatever remains in that goes to the community foundation, which may be named as a beneficiary of a charitable remainder unit trust. Why is this advantageous? Well, you pick the payment rate that your beneficiaries would receive. So again, if you're doing this for your children and you're philanthropic, because all of these strategies really only make sense if you're philanthropic, you would then name your children to receive this lifelong income stream. Typical payment percentage is 5, 6, maybe 7% maximum, because you also want the charity to receive some money, so you don't want it to be so high that it's going to eat down the principal. What you do, you'll name a trustee, which can be a trusted financial advisor if their firm allows that, or trusted friends, trusted colleagues, etc. The beneficiary will receive the annual valuation of that trust. So it's called a unit trust because, say you leave $1 million, year one, your beneficiaries, your payment rate is 5%, you would get $50,000. Say it goes up to $1.010 million, the next year they would get 5% of that $1.010 million, and so forth. So it's valued annually. And then when your beneficiaries die, the remainder goes to the charitable beneficiary. And if you do this with the community foundation, you would complete an agreement with us. Tell us how you want that money to be deployed philanthropically. So this is something you should definitely explore with your attorney, particularly, again, if you have an estate that's heavily invested in IRAs, if that's a big part of your asset base, and you want to leave money for your children, this may be an effective strategy for leaving money to your kids and being philanthropic. And then the last, I mentioned this only really in passing, there's a strategy called a charitable lead trust, which really should have been up there in the current giving strategies, but it's typically thought of more in an estate planning context. And that's the reverse of the charitable remainder unit trust that I mentioned. So in the case of the charitable lead trust, you actually set up a trust, and the community foundation would get an annual distribution of the percentage you name, again, typically 5%. And then at the end of the term of the trust, so these are always terms, so typically 10 years, maybe 20 years, the trust principal will go to your heirs. So this can be done to come back to you. If you do that, it's an income tax strategy. It's more typically done as a way of leaving money free of estate and gift taxes to heirs. So this is an important strategy to keep in mind, particularly if the top estate tax rate comes down, which it might with the current Biden legislation, but which it will anyway in 2025 when the current law sunsets. So again, definitely worth discussing with your financial advisor. So I think we're almost at time. And so I'm going to just wrap up by reminding you that as part of your current giving, you may make a gift, and I encourage you to do so, to the Community Foundation directly for our annual appeal, which is called Community Champions. You see here on the slide the benefits of supporting the Community Foundation. I'm not going to read these bullets to you. I'm sure you can read them yourself. But I would encourage you to realize that in addition to being your partner for your philanthropy, the Community Foundation also leads crucial work in our region, such as the work that I mentioned at the top of the webinar about our new strategic vision to close the racial wealth gap in this region over the next 10-year period, or to provide leadership in the work to close the racial wealth gap. And an unrestricted gift to the Community Foundation helps make that work possible.